colder in March than in February, and if we were not in quarantine, in the red zone, I would go to Switzerland to ski, but the conditions were fantastic. Hi, good afternoon, everyone. It's an honor to host Jay Pelosky once again at Home Research, Twitter and also YouTube accounts. As you know, Jay has been with us for a while. We host, this bi-weekly call. Just a reminder, Jay has been, spot on the most important asset on the planet, which is the U.S. Treasury, the U.S. 10-year bond, which is, what drives everything else. It drives, every other asset in the planet. So we have a lot to talk about today. There is still the rotation trade. There is, stuff in Europe, the emergence of Volkswagen, commodities. But I would like to turn to Jay, and we're going to start with him talking of all the activity in U.S. Treasury market that, happened in the last 2 weeks, which was the last time we spoke. How he sees that, how he sees the Fed, there's been the Fed meetings, and then, we can kind of take it from there and use that as a reference. So now turning over to Jay, thanks again. It's great to have you, and over to you.
Thanks, Roberto, and hello, everyone. Great to be with all the clients and friends of Home Research today. So yes, let's talk about the 10-year Treasury market. I think it's now probably been a month or so, Roberto, since we wrote our piece for the Brazil Journal saying higher rates are a good thing. And
it's actually a little over a month. I think that piece was either the 13th or 17th of February, but it's a little over a month, and it's been spot on.
Well, certainly there's been action in the Treasury market, but at the same time, from an equity perspective, obviously we've hit new highs. And so I think our argument that one should not get thrown off one's investment thesis because of a backup in rates has indeed been accurate. And I think, look, the biggest bad call or wrong call that the sell side had as consensus at the beginning of 2021 was that the 10-year U.S. Treasury bond would end 2021 yielding 1.2%. I pointed that out and said it was by far the biggest miss of all the various sell side pieces, and I stand by that. And look, we've gone a long way towards remedying that, because now virtually every single one of those firms, those big banks, have 2% at the end of 2021 or something around there. So one point is that we've come a long way in fixing what was a mistaken perspective by the market. So that's always a good thing. The fact that we've been able to do that without disrupting the equity market has also been a good thing, and I think reflects the strength of this equity market, that we've gone from 0.9 to 1.75 in less than 3 months on the 10-year, and the S&P is at new all-time highs. So that says to me an awful lot about the strength of the market. And so look, where are we today? Today, the Treasury market has backed up for 7 weeks in a row. There's almost never been 8 weeks in a row. Secondly, I'd point out that the long end of the U.S. Treasury market is the most oversold it's been in almost 30 years. And third, I'd point out that the hedged yields, so yields for a German or Japanese or Chinese investor, when hedged back into their local currency, now given the backup in rates, the 10-year yield is the most appealing to those buyers that it's been in several years. So a lot of things are lining up to suggest that we've probably seen the bulk of the move, at least in the near term. And obviously we have an important 7-year auction later on this week, I think for $60 billion odd in 7-year US Treasury bonds. And remember, it was a bad auction, or what was perceived to be a bad 7-year auction a couple of weeks ago, which really set all this off. And so, you know, let's pay attention to the auction and see the results. I mean, to me, the supply-demand dynamic in the Treasury market is going to be a factor going forward. The amount of new supply, I think B of A suggested a couple of weeks ago that the net new supply in the Treasury market will be somewhere close to $3 trillion of supply. $1 trillion more than a year ago and $2 trillion more than 2019. So obviously, you know, we're going to need to find buyers, and the price and the yield has moved to reflect some of that, and also to reflect concerns over inflation, which I continue to think are overstated. We will have mechanical, transitory, high headline inflation numbers in the US over the next couple of months, when the weak numbers, the negative inflation numbers of a year ago, when COVID really hit hard, drop out of the calculation. I think that's the issue that the Fed sees, and I was impressed by Chair Powell's comments and by the clarity of his comments, making it abundantly clear that the Fed is now data dependent. And I think we should welcome that as investors. Now we don't have to really worry about the Fed, I don't think. The Fed has told us what it needs to see before it will act. And now you can argue that the market is going to press the Fed and test the Fed and bond vigilantes and all the rest of it. But there needs to be some evidence over time of inflation becoming unmoored. And I think we're very, very far from that. So as I said in the Twitter tweet I sent out earlier today, data over dots, I'll take that anytime. I mean, the dot focus, when people say they hang their hat on dots of three years down the road, I mean, I think that's kind of, I never was a big fan, to be honest. And so to me, a Fed that wants to be data dependent, is going to be data dependent, is going to let inflation run hot, is going to seek full employment, is a good thing for equity investors. It means that the economy is going to be robust. It means earnings are going to be robust. It means the Fed is highly, highly unlikely to start raising short-term rates, which is typically what ends a bull market in equities. So to me, we're now at a point where one could argue, as JP Morgan did over the weekend in one of their macro pieces, that while the risk premia for treasuries has gone up, it's gone down for equities and for credit. And so I'm with the Fed watching for disorderly conditions, or for tightening financial conditions, or for blowups in the credit space. That's where we'll see some of the things that will concern the Fed. And so far, notwithstanding a very poor start to the year for investment grade debt, down about 6% year to date for LQD, the investment grade ETF, there's no sign of poor credit action or widening spreads or busted issues. In fact, issuance continues to be very, very robust in the credit space. And so for me, I'm in the camp that says we're in pretty good shape. We've adjusted and dealt with one of the big offsides calls, 1.2 10-year Treasury at the end of 2021 never made any sense if you really thought the economy was going to grow at 6%. So now we're at 2%. I think that's much more in the line of reason. And I'll just point out, Roberto, that there's no real relationship historically between strong growth and higher inflation. In fact, there's only been a handful of years where US GDP has grown more than 6%, and very few of them actually had sharply higher inflation. So it's kind of like growth and stocks. People say that strong economies tend to have strong stock markets. There's no relationship there. You look at China as an example, very strong growth, lousy stock market. So stocks work off of earnings streams, not off of GDP. Inflation and the Treasury market, I think, are in pretty good shape. Watch the supply demand, watch the credit space. But I think I continue to feel that one should keep calm and carry on, as we said over a month ago.
No, that's fantastic. And we talked about inflation a bit, and there is this story about oil and what we're talking about. So should we worry about what's been happening with oil year to date? I mean, is that going to feed into higher inflation expectations? Is that going to be seen as transitory? And how do you see, in general, what's happening in the market? I mean, there's a big debate on whether oil is kind of a lagging issue and not so much forward. But some other people would argue that there is a correlation between the tips, the implied inflation and also the oil price. So how do you see that?
Well, I did actually note that 2 weeks ago in the Musings, Roberto, where I highlighted a gentleman named Mark Chandler, who pointed out that the correlation between the 10-year rate and the Brent market was about 0.95. And last week was interesting because that relationship broke down, at least for the week, right? Oil fell sharply, and yet the long bond kept backing up. And so to me, again, it's another example of how markets are working these days, what I call a pothole market, where you're going fine, and the oil market was hot. XLE, the main energy or oil ETF in the US, was up 40% year to date through the middle of last week, and then took a couple of days where it was down 4 or 5%. And that's just a pothole. It's perfectly rational and it's healthy. Things don't grow to the sky. So when you're up 40% in less than 3 months, you probably should expect a pullback. And so we had a pullback in energy and in oil. To me, I think there's a case to be made that supply-demand dynamics in the oil market are favorable for higher oil prices. I believe JP Morgan has a $84 target in the second quarter of next year for the peak in oil. We're at $60 today in Brent. So I'm relatively comfortable with a higher oil price as the economies reopen and it becomes a global reflation story, not just at this point kind of a China and US reflation story. And I really don't see it as causing significant amounts of inflation pressure in the US. Gas prices have gone up, sure, but it's not a particularly big factor in inflation, and not really at all in the core or the core PCE, which is what the Fed uses to measure inflation. So headline inflation gets all the headlines, but it's not what the Fed looks at, and we should be concerned with what the Fed looks at.
That's fantastic. And one thing I just thought would be interesting to talk about is because that affects the growth outlook and everything. And also you talked about headlines, and there were some headlines about it today. is on the political environment in the U.S. So, I mean, the Biden plan, and then there were some people talking about, another $3 trillion on infrastructure. So, can you comment, because this, happened over the past 2 weeks? I mean, were you surprised on how fast, the fiscal plan was approved? And how do you see, the next step from here? I mean, when we talked about, last time, there was the story of, okay, they're going to announce the infrastructure and also the climate plan towards the end of March. So, I mean, how is this going?
Yeah, I think I'm very focused, Roberto, as you may recall, with this idea that we're in a major political transition in the United States. I know we've spoken on one of these sessions in the past, but more than happy to repeat it because I think it's a critical point. And that is that the U.S. is moving away from 40 years of the thesis that government is bad and should be as small as possible. Really beginning in the Reagan years with his famous 9 words, I'm from the government and I'm here to help, which he called the 9 most terrifying words in the English language. Okay, most terrifying words. I'm from the government and I'm here to help. And now we are in the Trump administration was a natural end point, because remember, the Trump administration's main objective was the complete deconstruction of the administrative state. So these were not just words, this was policy and philosophy, and ended up leaving us with COVID in the response of the Trump administration to the COVID pandemic, which was subpar at best. And so now we're in an environment that's completely different. We have massive challenges. We need to get a handle on COVID, which I think we're doing in the US. We need to deal with climate, which is, again, an existential issue. We need to deal with inequality. So there are huge issues in the United States. At the same time as there is very cheap money, interest rates, whether at 0.95 or 1.75, still in real terms negative, and very low in nominal terms, suggesting that lots of investment could make the return necessary to pay the debt and add value. And we also have a Biden administration that is staffed with ex-Obama people. And the Obama people know that in 2009-10, when they made their stimulus to deal with the great financial crisis, it was too small. And it had the effect of leaving us politically in a very divided place in the United States. And so the Biden administration, very interesting. It's very calm. It's very quiet. You don't see the president tweeting or, riling feathers, but very focused on going big and going fast. So going big was a 1.9 trillion rescue plan done purely on what's called reconciliation. So there was an effort to bring some Republicans on board. That effort was not successful, and the Democrats moved completely ahead on reconciliation, which doesn't require any Republican support. And so these are efforts that suggest a much more kind of politically astute administration than perhaps the Obama administration, and an administration that recognizes it has a unique opportunity. Because if the Biden administration can get COVID under control and can lead to a much more robust U.S. economy, then the elections in 2022, the midterms, and in 2024, the presidential, could go much more favorably for the Democrats. And so in that regard, the infrastructure and climate plan is likewise likely to be quite big. People have said several $1 trillion. It's likely to be partially paid for, perhaps as much as 80%, by tax increases. So this is important in terms of if you're thinking about inflation, thinking about interest rates, thinking about another huge government program. Doesn't that just blow out the deficit, spike interest rates, and create a problem? Not necessarily. One reason is that I've seen references to 70 or 80% will be paid for by tax increases. The other point is that infrastructure is going to be spread out over a period of years. Remember that in the United States, the vast majority of infrastructure projects are state and local projects, not federal. Therefore, they take time, they roll out differently, and therefore this is something that's going to, not like the rescue plan where the money hits very quickly. The infrastructure plan will roll out over time, will hopefully have a major climate component to it. I believe it will. And will be something that I believe the administration is going to present in the next 4 to 6 weeks. And that should be something that, again, we can all look towards as a way to kind of cement a stronger U.S. economy that deals with climate. The one other point I would say is that it doesn't offset the likelihood of what's called a fiscal cliff in 2022. Because remember, much of the rescue plan were one-off programs. They expire after a year. And so when you're worried about inflation and you're worried about sustained inflation, you have to kind of argue about the fiscal cliff as that money rolls off and infrastructure takes time. You also have to argue, and I forgot to mention this earlier, about the velocity of money, right? There's one thing when there's a lot of money around. It's another thing when that money is coursing through the system, moving rapidly and prices changing rapidly. Velocity of money in the US and in most of the developed economies is virtually dead. There's virtually no velocity of money. And so that's another thing that you can look at. And when you talk to someone who's really bearish on inflation, worried about inflation really taking off, ask them about the velocity of money, because at this point there is none.
No, it's a great point, and you know, I keep going back to this theme because people still do not understand, you know, what this change in ideology means for the investing environment and how things are going to be different over the next 5 years or so. And since we spoke last, there have been long articles on the Financial Times especially talking about what does this new ideology, this whole Biden plan, what that means. It adds about 1% to global growth, but I don't think that change in mentality is still there with investors. And I mean, let me know if you agree. And it's a different kind of mindset that you need to navigate this new environment.
Yes, I agree completely. And that's one of the challenges and opportunities for investors, is that we have regime shifts in virtually every facet of, as a global macro guy, if you think about health as a starting point, COVID speed, which I've talked about at length, now migrating out of health into climate in other areas. The fact that you have global intellectual and financial capital focused on a single issue, leading to multiple effective vaccines developed all around the world in 1/10 of the time it's taken historically. That is a paradigm shift. That is something that we really have to come to grips with as investors and understand that same intellectual capital and financial capital is now being focused on climate, being focused on cyber, being focused on the nexus between fintech, traditional banking, and crypto. This is a major, major change. And then you think about economics. We're talking about the fastest global growth in 50 years. So most of us investing today have never invested in this kind of an environment. And therefore, it makes sense that people are concerned about inflation and things of that nature. But it's an opportunity as well as a challenge. And then you think about politics and the regime shift we just talked about. 40 years, Ronald Reagan was in the early 1980s. We're now in the early 2020s. We're talking about 40 years of thinking that government should be shrunk. Now we're at a point where COVID has led people to say, we want more government. We need more government. And that is a philosophical shift, as you pointed out, that's going to have major ramifications around the investment space. Think about what it means for fixed income. Think about what it means for currencies, for equities, etc. And then you think about the markets and what it means for the markets. We have a bear market in U.S. Treasuries. The last time we had a bear market in Treasuries was, again, 40 years ago. So I believe we are in an environment of secular bull market in equities, in a secular bear market in bonds in the United States and globally for the most part, which we haven't seen again since the 1950s and 60s. So, and you can go back and look at what markets did in the 1950s and 60s, but then you have to think about today's interconnected world with high frequency trading and all the rest of it moving very, very aggressively. So that's why I talk about pothole markets and things of that nature. But to me, the regime shifts across the board are dramatic. They're powerful. They will impact investing. And I kind of see it as my job, my role, my opportunity is to kind of help people understand how all these things are happening and how they interact with each other and what it means for the investment opportunity set.
No, fantastic. And I'd like now to go to the topic of your conversation this morning with Bloomberg. Jonathan Farrow, and him being in Europe, and that's one of the regions you're most optimistic. Can you revisit a bit your thesis on Europe, and especially putting into perspective what's happening on the vaccination front? I mean, a lot of people have been and rightly so, calling it a failure to a large extent, and after this AstraZeneca episode, I mean, can it be fixed, and what it means for the European investment case?
Sure. I had a good conversation with John this morning, as we always do. He's a great anchor. I think he's one of the sharpest guys on the TV side of things. And so, look, we talked about how there are three big divergences at the moment. There's the divergence between the U.S. vaccination process and the European vaccination process. Very wide, right? U.S. is now administering 2.5 million to 3 million shots a day. We're going to be at herd immunity most likely by early June. Europe, as we all know, is struggling to kind of get out of the gate in terms of its own vaccination process. Several important countries having to go back into lockdown, all sorts of arguments about, who owes what to whom and who has the vaccines, etc. So that's one divergence. I happen to think it's about as wide today as it's going to be. And so that divergence I expect to narrow. And remember, markets are forward-looking. So the market is arguably pricing in a narrowing of that divergence. The second divergence is between the growth profile of the U.S. and that of Europe. U.S. is probably going to grow about 5 to 6% in Q1. Europe is likely to have negative growth in Q1. But again, remember, we don't invest on growth. We invest on earnings. And earnings in Europe in Q4 were way better than expected. Had the best breadth of earnings beats in a decade. So that's something to keep in mind when you're struggling to understand why Europe, equity-wise, is doing well and actually outperforming the United States. The third divergence is within Europe, and it's between the manufacturing, which has been very robust, and the service sector, which has been very, very weak given the lockdowns. I think that too is at its wides. So where this is going to be expressed, I think, is mostly in the currency, because U.S. exceptionalism, when the U.S. is doing better than everybody else, that's bullish for the dollar. And we've seen the dollar make a little bit of a move up, but very muted, very limited. Global reflation is bearish for the dollar. And so I think that's the tug of war between the dollar. The market senses that Europe will get its act together on vaccinations, that will lead to a lifting of the lockdowns. It will likely mean that the service sector expansion in Europe might be more robust than elsewhere because you'll be coming out of true lockdowns. We haven't been in lockdown here in the US in months and months. And everybody's super excited about the big liftoff. So to me, I told John this morning, and I'll share with your audience, what I see as a triple play for Europe and for value versus growth. I put it in the context of the shift from growth to value because Europe represents value. The DAX, for example, trades at 15 times forward earnings versus 22 times for the US. European banks, which is one of my favorite sectors in the world, trades at 0.6 times book versus well over 1 times book for the US banks. And so there are really three factors. All three disciplines are lining up. You have the fundamental factor of the vaccinations and rising rates being kryptonite for big tech. Again, something you and I have talked about. I've been writing about it since last fall. That's playing out exactly as we have talked about. That's bearish for the US. That's bullish for Europe because Europe has less technology. Bullish for Japan, same thing. Then secondly is the technical analysis. And I mentioned in my musings, one of the most respected technicians in the US, a gentleman named Marty Pring, came out last week and said that the long-term leadership in the US is shifting away from technology towards value, towards energy and other sectors like that. And then the third point is the quantitative discipline, where you have JP Morgan and Alpine Macro and others starting to talk about how momentum is shifting away from growth, which has been paired. That's been like a paired trade, that growth and momentum together for the last decade now is switching towards value. And you were talking earlier before we went live, Roberto, about how we're in the 1-year anniversary of COVID and the absolute low of the COVID sell-off. And that's also the same point at the bottoming of value versus growth. And so JP Morgan and others are making the point that the systematic traders, the quant funds and others who follow these signals are going to be switching from growth into value. And so that's something that I think is going to provide another leg up for value within the US, but also value globally, which will benefit Europe. And you also have, as I said, I think the likely dollar weakness, which should further help European equities. And so I think there's a case to be made, a pretty strong one, that we're at the wides, the widest points in these divergences. As they narrow, markets will respond. The dollar is likely to weaken. That will help European equities. And the last thing I mentioned, just a sentiment point, but it's interesting to me. Morgan Stanley, my old firm, hosted a European financials conference last week. It was virtual, but nonetheless, they hosted it. And they pointed out that the audience for this was up 50% year over year. In the US participation was up 100%. That is telling you that big money is starting to pay attention, wants to get educated and understand what's going on in the European financial sector. And the last point, and this blew me away when I read it, the US banks have now regained their pre-Great Financial Crisis highs. Okay, so they're back to where they were before the GFC. Do you want to take a guess, or should I just tell you how much the European banks would have to go up to get to that point?
How much? Threefold.
How much?
Threefold? Fivefold.
Fivefold.
Yeah.
550% to get back to where they were pre-financial crisis.
No, it's amazing. I mean, I think, of course, there was a lot of dilution in the process, but, still, it's been the worst asset quality on the planet. So, I mean, if you have things, going okay, I mean, moderately okay, I mean, there's a lot of money to be made, and then you have the issue on the rates, you have cross-border consolidation, you're going to have a joint rescue fund. So all of that points in the right direction, and especially if there is the resurgence of the domestic economy, I think it can work pretty much well.
Yeah, you have the potential to restore dividends and share buybacks. That's starting to happen. Same thing in the U.S. Everybody was really upset about the banks sold off because of the Fed didn't renew this SLR leverage ratio. But the point is that if the banks are adequately capitalized, then the Fed is probably going to allow them to start to provide dividends and go back and do share buybacks, which they have not wanted the banks to do. That to me is much more important as an equity investor. The Fed is basically saying things are okay at the banks. They're well capitalized, and therefore the next thing they hear from the Fed about banks is that they're going to be allowed to start to provide dividends and buy back shares. And I think the same is going to happen in Europe. And I think also in Europe, there's going to be, as there is in the US in the regional banking side, I think there's going to be tremendous potential for M&A in the banking sector. You're already seeing it, as you know, in Italy and in Spain, domestic M&A. Yeah. But I think there's also real potential as we move forward with issuing joint debt, and we start to do joint taxation in Europe at the digital and at the carbon level. And by the way, very keen on carbon if we want to talk about climate. Yeah. But that there's potential for common deposit insurance. And once you get going down that route in the banking union in Europe, the potential for cross-border M&A in the European financial sector is significant, and I think will happen. So there's many reasons to be constructive on European banks, and to me, the fact that U.S. Investor participation in a European financial conference was up 100% year on year. I mean, really, to be honest, that tells you almost all you really need to know.
Absolutely, and I would like to go back to carbon, as you mentioned, but I have two follow-up questions on Europe. One is, what do you really think went wrong on this whole blame game? Was it AstraZeneca or and you have the confidence that they will step things up as it seems. And the other one, you mentioned the divergence between manufacturing and services. I agree, but then I would like to add one aspect which has to do with carbon to some extent, which is the Volkswagen first, but then the BMW announcements. So they made this very big announcements about EVs and how they want to displace Tesla. Well, not so much BMW's case, but VW's case, where they expect in 2025 to outsell Tesla in EVs. So what does that mean for your bullish case on Europe, and especially the DAX has been breaking out because of the importance of the auto sector?
Yes. Okay. First on whether they're going to get the vaccination process kind of reorganized. I mean, I certainly hope so. I mean, Europeans are perfectly smart, capable people. They do have the fact that, kind of like in the States, in the US, they're all 27 different states within the EU. And notwithstanding that Virtually all of them have very good public health systems, unlike in the US, where the public health system has been starved of money, going back to the issue of, government is bad. So I think that there's certainly capability. There was obviously some poor decision making around securing vaccination capacity, right? The ability to have the vaccines that you needed and the number that was needed. That's clearly been a problem. The US, for example, has dealt with that. And the issue is demand. We want to make sure that more and more people get the shot. So in New York, for example, they just today lowered the age where you can go and get a shot to 50. It was 60. 2 weeks ago, it was 65. And so I do think that, the UK has been able to be very successful with its vaccination program after, having a huge, mess in dealing with COVID at the onset. So hopefully we can look at something like the UK and say that the EU similarly has struggled to get off on the right foot. Hopefully they have the capacity and the ability to do so. And I think that right now going back into lockdown is meant to bridge the gap between where we are today and where the supply of vaccines are going to be sufficient. And so that intervening, whatever the period is, a month or so in the case of Germany, in the case of Italy, in the case of France, that dampens down the variants which are spreading widely, and then gives you the opportunity to get your vaccine supply under control and in turn start turning the tide on that. So to me, that is what I expect and what the market expects. And again, the markets are forward-looking, so it's perfectly understandable once you understand that point, that to see that plus the better earnings profile, as I touched on, to see why European equities are actually outperforming. Plus, remember, Europe sells a lot to Asia and to China, and Asia is a very solid shape, and China is growing quite rapidly. So that's another thing to keep in mind. Europe is not, a closed system that only sells and deals within itself. So that's the vaccine point. On the question of electric vehicles, we were touching on this before we went live. I made the point, and I think it's correct, though I haven't studied it, that if VW had made this move 2 or 3 years ago, they probably would have been sufficient to really challenge Tesla. I think at this point, Tesla is here to stay. And the question of can both survive and thrive, or 3 or 4 electric vehicle producers survive and thrive, I think absolutely. This is going to be a humongous market where more and more countries are pushing to be selling only electric vehicles within the decade, from 95% or 98% internal combustion to 100% electric vehicles in less than a decade. I think there's going to be room for everybody to be successful. And it's going to be a question of who can take the bigger pieces of a very, very large and expanding pie. So now you have Tesla, you have the Chinese producers, you have Volkswagen and BMW, you have General Motors here in the US, made a strong move in this direction a month or so ago. So you're going to have competition. And to me, that means, again, as investors, we need to be participating in this, whether it's through electric vehicle ETFs, whether it's through battery ETFs, whether it's through clean energy ETFs, whether it's through pure Europe or DAX, EWG to play the breakout of Germany. I mean, as investors, we have the opportunity set and the instruments through ETFs to easily participate in these themes. And that is where I think the real alpha generation is going to come from in the next couple of years, is going to be integrating these thematic opportunities into already existing global multi-asset portfolios. That's a challenge and it's an opportunity. And that's one I think where investors really need to be either getting expertise. They can come to TPW Advisory for that expertise, or developing it themselves. But to me, that's where the opportunity set lies.
No, exactly. And the important thing, what people found the most interesting in the VW statement was the announcement was what they said about batteries. So I think it's going to be, like 5, super, factories across Europe. So I think people understand that that's where, most of the value is. And I was discussing with someone who has looked at the industry, for a long time. And looking at the profitability of the EV, vis-a-vis the internal combustion engine, it seems that the ICEs is still a lot more profitable than the electric vehicle, despite being a lot more complex. Which means that the battery is a very important cost component, and that's what really drives the profitability. So, and that has a whole set of implications. So, and now going to carbon. You mentioned you wanted to talk about that. So if there's anything else you want to add on that front.
Yeah, no, I would just say that in terms of the battery cost, keep in mind that the cost is declining rapidly and dramatically. And I expect, again, to go back to my idea of COVID speed breaking out from health to climate, and to recognize that you now have European, American, and Chinese producers all focused on this. Again, it's the same thing. Global intellectual and financial capital focused on cheaper battery production to save the planet and to meet the objectives of going to all EV production within a decade. That's what I'm talking about. That is a absolute tremendous change. And it reflects the fact that kind of to, the way that I think about the world in terms of the tripolar world, right? You have European producers now getting in the game. Europe wants to make sure it has a semiconductor industry, wants to make sure it has an electric battery industry, an electric vehicle industry. The United States wants the same, the Americas, and Asia wants the same in China. And so again, from the perspective of global thinking, that this idea of regional deepening and regional integration in these 3 regions are going to drive activity. The climate and the tech stuff reinforces this push towards regional integration. The VW news reinforces that Europe needs to be, wants to be, has to be, will be a player in the electric battery space, because it recognizes if it isn't, it's going to have to buy that technology from either the Chinese or the Americans, and it doesn't want to do that. And that can be replicated in the semiconductor space, in the health space, et cetera, et cetera. It's fascinating, but I think it again should hopefully be clear to the audience that this is the way I've been thinking for a decade. That this is not, I added technology and climate to my tripolar world last year, over 15 months ago now, specifically added 2 new drivers, technology and climate, to the tripolar world thesis. So this is something that we're not surprised about. I'm not surprised about, but I think it reflects the opportunity set. And again, this idea of global capital and the speed at which these changes are going to take place are going to leave people very, very surprised. So you need to kind of get on it. And then it's a question of sizing and positioning so that when you have the potholes and you get a shakeout, a 10 or 15% move, ARC, fell 40% in the space of 6 weeks. Bitcoin fell 40% in the space of a couple of weeks. These things move aggressively. And so sizing and positioning is absolutely critical. And one of the things that I've done to kind of protect against these is to pair them old energy and new energy, right? We talked about this, XLE and ICLN, or XLF for the financials with ARC FinTech. I mean, there are ways to do it so that you can participate. And one of the things that's been interesting and that I added to our model portfolio several weeks ago at the beginning of March is carbon, and the symbol KRBN in the US. And it's the carbon offset market that has been developed primarily in the European Union. And when people start to talk about carbon offsets, and now the talk is to push companies to publicly identify their carbon footprints, which is going to require lots and lots more companies buying carbon offsets, which is going to mean the price of those offsets is going to go up, and up significantly. So experts are talking about $150, $160, $180 a ton for carbon offset. And the price now is in the 30s. And KRBN is one of the only ways to play the pure offset market. There are other carbon ETFs, but they are more company specific, and they include the same companies that we all know. One of the challenges within the clean energy space and the EV and the battery space is that many of the ETFs hold the same companies. So you have to be careful not to kind of double and triple up half a dozen companies. And that's, again, one of the reasons why I like this particular instrument. It doesn't hold any companies. It's purely the offset market. And I do believe that going forward, carbon pricing in the US is going to be critical. Carbon pricing in Europe is going to be much more visible. There's talk of a carbon import tax, right? I saw that. Be very, very big. And it's increasingly becoming an issue in China and in Asia as well. So that's one of the things that's so exciting about this time, Roberto, is that there are so many things happening and so many big changes that as a macro investor, the opportunity set is just tremendous to express, different themes and to participate in these things at a much earlier stage than has been the case before. I really do think that the IPO boom, the SPAC boom to a limited extent, is starting to disintermediate the VC space in allowing the public market investor, you and me, the public market investor, an opportunity to get into these themes much earlier in the innovation adoption cycle, which means lots of potential for big gains. Also, some things are going to go to zero. And so like a VC fund, as you and I know, it's not as if every company in their fund is going to do great. Most of them are not going to do great, and one or two is. And so for public market investors, we need to think similarly. And that go back again to the issue of sizing and positioning within a portfolio. It's absolutely critical, because otherwise, when something like a ARC or GBTC or something else in these different thematics goes up and down 40%, it can blow up your whole portfolio if it's not sized properly.
No, fantastic, and I totally agree. And you mentioned this for a while about investing thematically, and there's one more issue we have to talk about. We talked before we went live, and we have like 6 minutes, which is the local bond ETF. So where you think there is a great opportunity, and I agree on how if the divergence on the EU versus US vaccination begins to narrow, how that's going to lead to the appreciation of the euro, depreciation of the US, and how that impacts the local bond ETF, because I think that's a very interesting analogy. And then I'll write down the name of the ETF.
Sure. Well, we can get the ETF out of the way quickly. It's EMLC.
EMLC.
So market local currency. The other one is EMB, which is the dollar denominated. And so look, it's hard to find yield in today's world. The yield on EMLC is about 5%, which is pretty good. The biggest single country is China, which is pretty amazing. I bet most people wouldn't think about that. They know it's the biggest in the equity space, but in the emerging market, local currency, bond, ETF, China is the single biggest country at about 10%. Then is Indonesia, then Brazil, and then Mexico, I believe. Turkey, for example, is not even in the top 10 of the countries in that particular ETF. And so I thought it's always good to see when you get some news and a sudden surprise to watch how things react. And so I watched particularly today EMLC after the Turkish news. Over the weekend, everybody gets worried. You know, the lira is down 8, 10%, whatever. EMLC barely budged today. It was off about 0.5%. And most interestingly was that the volume was tiny. So there was no selling pressure. I thought that's really interesting. So the people, you know, people are not in EMLC. They're not really in any duration instrument. And EMLC duration is not, it's not super long, but it does have some duration exposure to it, obviously. So to me, that's a good signal that A, the instrument did not go down with a negative shock. B, there was no selling pressure. That's also very good. C, we can make the case as to why the dollar is likely to weaken as the rest of the global economy recovers. And then D, you have an instrument where you can put a certain amount in the portfolio and watch it. There's probably limited downside here. Again, we've seen a big shock, 0.5% down. That's perfect. Limited downside and some pretty decent upside if people start to get enthused on non-dollar currencies, if the vaccinations work. Obviously, there are some ifs. There always are in the investment space, right? There are no guarantees. And if someone gives you a guarantee, you should probably run away very fast. No guarantees. But I thought the action in EMLC is very interesting. It's in our model portfolio. And I think it's going to be probably a pretty decent play here over the rest of 2021.
No, that's fantastic. So I think, you know, we covered a lot. I mean, we started with the action on the U.S. Treasury, then talked about oil, commodities, you know, the EU, you know, talking about the banks, you know, your favorite, but also the EU, you know, as a region and this whole divergence, which I think is very interesting. And then, you know, kind of closed off with energy and now the local currency bonds. So if I were to ask, you know, in the 2 minutes or so for you to wrap it up, you know, things, I mean, of course, you know, the call has been very good and very, very consistent over the last 6 months that we've been working together. But if looking out, you know, 6 to 12 months, what would be, you know, your 5 main ideas? I mean, where, I mean, there are.
Come on, that's not fair. At the end of an hour, you want me to come up with 5 ideas over 12 months? Wow.
Yeah, or
how do your kids handle that? Boy. You know, to be honest, I think what I would say is that we're in a secular bull market for equities, so don't get shaken out. We're going to have pothole corrections, but markets are going higher. Non-US is going to outperform. Value is going to outperform growth. We're in the first or second inning of the move towards value. First or second inning, and the 9 inning for, you know, American baseball, 9 innings. So at the beginning of this, and I think that the dollar is going to weaken. You're going to have tremendous deficits, both current account and fiscal, and the rest of the world reflates. The dollar will weaken. That should again provide upside to the non-US assets. And remember that the US has been the place to be for a decade. And so there's a significant amount of money that can move out of the U.S. into the rest of the world. And I expect that we will see that over the coming 6 or 12 months. There will be things that get overheated. And so one needs to be a little tactical as well as strategic. So strategic, stay the course, keep calm, carry on. Tactical, when you get something like an XLE up 40% in 2.5 months, you should probably take a little bit off the table.
That's fantastic. Yeah. So don't get me wrong. I mean, I think the idea was just, to have kind of a recap, and people can, if they have to focus on something, focus on these 2 minutes. And I think the key message is there. So, it's a big regime change. We're just starting. There's a transition from value, from growth to value, that is just beginning. So the second out of the 9 innings. And the most important thing is, there's nowhere to hide in bonds. So that means, in the 60-40 portfolio, you gotta, find other places to put your 40%. But I think that summarizes both, and then the rest is people have to listen to the whole in 1 hour, or they go out and look for you for TPW advisory.
Yes, exactly.
And if people don't know where to find you, they can ask me, and I'll direct you. But I once again, I'd like to thank you very much, and it's been a great discussion. Already looking forward to 2 weeks from now. I think it's going to be April 5th or something. But yeah, it's going to be on people's calendar. And thanks again. It's been very interesting, and it's going in line with what you have said. So let's keep going. And as you say, keep calm and carry on.
Exactly. Thank you, Roberto, and thanks to all your audience. And please do reach out with any questions, and look forward to, as you say, another Musings in 2 weeks. And then, of course, my work is up on your site every Friday morning or Friday afternoon. Tends to be more Friday afternoon. There's been so much to cover.
Depending on where you are on the globe, right?
Yes, exactly. But look forward to continuing our relationship. And thanks, everyone, and have a great night and a good week.
Likewise. Thank you.
Bye-bye.